Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. Okay, so there is some movement this past week on the major pattern on this daily chart. Last Tuesday, the market broke down through the dark blue lower bear channel line, currently at 1980 of the late September to mid-December dark blue bear channel, currently at 2197 to 1980. Now, this developed from what was originally a descending wedge pattern, morphing into a larger bear channel. Now, we haven't as yet sped much lower other than towards the bright red, previously breached, August 2022 to date uptrend, currently at 1941. But is a break below the bear channel, thus a primary target X below for this pattern move would be in the 1850 zone, with a further, much harder to reach secondary target X1 down in the 1760 zone. Now, the primary target seems doable, especially after I had for weeks said, and I quote, to look at the whole early September to day action as either a topping action with potential back down to the 19 cent zone, maybe now lower, end of quote. We have been within spitting distance of 19 cents, so it's only a short step further down. So what do we have in the way below? Well, apart from the bright red breached uptrend, there are two key 50% Fibonacci levels in the way. So the 50% Fibonacci line for the April 2020 to November 23 move at 1859, and then the 21st century 50% absolute Fibonacci line at 1809. These seem the main obstacles lower. Topside, once above the dark blue broken bear channel line, we have that old congestion dating from January to February 2017 between 2010 and 21 even, with some more modern resistances thrown in there at the long moving average, currently at 2030. Then at 2047 and between 2069 and 2084, and further up, actually above that congestion, 2140 to 2148. Ice Europe white sugar in London. From the lopsided island top formed over late September, this market has been gradually moving sideways to lower, initially getting itself trapped between three moving averages, but 2 weeks ago breaking lower and consolidating that break lower, unlike the move in mid-November. This break lower 2 weeks ago pushed down through a fairly clear area, once clear of the flatlining medium moving average, and that's currently at 549.10, bar some congestion dating from May and then again between July and September this year. Prices last week halted a decline at some congestion from early 2017 between 509.5 and 514.5, as well as just ahead of the August low of 501.40. Today we are testing back upwards, pushing up through the October 22 low at 514.5 and now testing the September 22 low of 517.80. To be honest, apart from some recent congestion overhead, we don't have much in the way past that until prices start looking at a combination of the March 2017 high at 548.70 and a flatlining medium moving average. So be on the watch for some interesting attempts higher, shall we say. Sugar white premium spread. Now, 34 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to London's sugar month changeovers, but it nevertheless was a seminal moment and set in motion a lower market, though prices took their own sweet time in getting down there. I spoke 14 weeks ago about the supports below, and I quote, "The next support of note would be the lows of the first week of February 2023 at 83 even, the mid-February low at 83 3/4, and the early February low at 81 3/4, end of quote. I continued further, it's an important piece I dealt with, and I quote, "The only other feature to consider is the new one I've drawn on my weekly chart, which is not as yet established, but which deserves consideration. It's the April to date descending wedge pattern, currently 67 3/4 to 93.5. This is still a nascent pattern, but one worth watching," end of quote. Prices breached and closed below this pattern in September, but we have seen only a limited follow-on lower since then, certainly not on the scale such a pattern deserves. Instead, prices have seemingly congregated around the important purple neckline extension to the significant February to September 2020 head and shoulders top, and that's currently at 77 even. The market did manage to press lower 6 weeks ago, dropping down to below the November 21 low at 68 even. But despite such a strong move lower, prices were not able to sustain the move down, and we are back up now, back within the descending wedge pattern, though admittedly this time capped by resistance in one way or another from, as I quoted earlier, the lows of the first week of February 23 at 83 even, the mid-February low at 83 3/4, and the early February low at 81 3/4. End of quote. I will, as I said last week, and I quote again, now be watching carefully the action between 85 overhead, 85 even overhead, and the purple neckline below. End of quote. So what have we in the way of opportunities and barriers on the downside and on the top side? I'll try and keep it simple and short, as the much larger picture has even me somewhat scared. So below the dark blue lower trend line, we still have the November 2021 low at 68 even, and then the congestion between 55 even down to 45 even, dating from July to September 2021. In the bigger picture, well, I'd previously looked for opportunities presented by the break below the descending wedge pattern. The primary target, as I said in previous commentaries, had earlier been reached. However, the secondary, harder to reach target, much harder to reach target, X1, well, that's quite a long way lower, way down in the 1 even zone. Yes, 1 even, and this has gotten me somewhat scared now for a number of weeks, as this is way below what I know to be prior lows here, notably my 2009 low at 22 1/4. All this is without even considering the implications, and this is the bit that really gets me, without even considering the implications, just possibly the move lower may have triggered targets finally for the huge 2022 to 2023 diamond top pattern. And on that, well, I shudder at the thought of it. There's also the possibility that the descending wedge pattern is now morphing into a big bear channel. That's currently 34 1/4 up to 93 1/2, which I don't discount, but which I'm also not too keen on after seeing the way prices have hugged that purple neckline.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.